Good afternoon and good morning, everyone who's joining us from different parts of the world today. I'm Melissa De Marais, the Executive Director here at Highwater Women, and we're very excited to share with you today the Road to Net Zero, Project Drawdown, and the investor's perspective. I want to tell you a little bit about Highwater Women and our mission before we get started with today's session. Highwater Women is dedicated to the economic empowerment of women and youth, and we do that through three core programs. We teach financial literacy, and to date, we've reached over 10,000 people with our financial literacy program and trained and deployed 3,200 volunteers. We've delivered almost 160,000 backpacks and holiday gifts to children and family in needs. And we have a whole program stream on impact investing, which is what we're here to talk about today. A little bit more on that. Our impact investing work started in 2013, and we held the very first Investing with Impact Symposium here in New York City. And to date, we've engaged over 2,200 people, 371 speakers, over 122 sessions. And we do that in a variety of ways, virtual sessions like we are working on here today, panels, workshops, roundtables, and networking events. So our goal here is really to do kind of field building work in impact investing and help people understand what it is, how it works, and how you can deploy it within your own portfolio, whether you're an individual or an asset manager or an institutional investor, really understanding the best practices and opportunities to implement this in a better way. We're excited today to be talking about Project Drawdown and the investor's perspective and looking to solve climate change. We have a part 2 to this session. I just want to let you know some upcoming events coming up on February 23rd, where we will bring investors and stakeholders together to talk about specific funds that are executing well against this strategy. We do have a call for nominations out there. Happy to share that information with you if you are interested and have not seen that already. We also have a session coming up on March 2nd, featuring Gloria Nealand at Triling Global to spearhead a conversation about funding women entrepreneurs. So check those out if you haven't seen those already. We are looking for corporate partners to partner with us in all areas of this work that we do. And we are a small nonprofit and operate off the gifts of generous funders and donors to our work. So without further ado, today, let's dive in and get to our conversation. Our agenda, we're going to open with a keynote from Jon Foley at Project Drawdown. Then we'll have a roundtable conversations with our panelists and then open the floor for Q&A. To interact with us, use the Q&A to pose questions, use the chat function to communicate with each other. And as always, if you have any questions for me about the work of Highwater Women, there's my email. Please feel free to reach out. I'm going to turn it over to Imogen Rose-Smith, who's the co-chair of the Highwater Women Impact Investing Committee. Imogen.
Hi, thank you. Thank you very much, Alyssa, and thank you everyone for being here today. This program, putting together this program has very much been a labor of love. So, and just a lot of work. So I want to thank the Impact Committee and especially the climate group that worked so hard on this, including Yana and Melanie, Andrienne and others. And also Corie, sort of my partner in crime or our partner in crime for Project Drawdown, who did so much work on this, and Alyssa for all her patience. So with that, I'm excited to introduce Jon Foley, who can tell you about the Project Drawdown project, and some of the data and work that they've been doing, which I think will be really compelling and important for investors. Jon.
Great. Well, thank you very, very much. Let me see if I can share slides here. Excellent. Well, thank you all for the opportunity to chat with you today about climate solutions and to have a conversation with investors who are thinking about this, which is a critical area, of course, for moving forward. I'll be talking about the idea of Drawdown, which is a plan and kind of a science-based, but also hopeful plan to address climate change into the future. But as we think about the future, I always think it's important to stop and reflect on our recent past of, how did we even get here? What happened to put us into this dilemma in the first place? Well, the world has always had affecting the environment. We humans been affecting the environment since we invented agriculture or fire or the wheel or been hunting and gathering. But in the last few decades, our impact went from a local kind of nature of impact to a truly global transformational impact. And that's because of several things. One, of course, there are more people in the world. Also, we've become an urban species for the first time, requiring very different kinds of infrastructure and relationships to agriculture and land use, for example. But most of all, it's the growth of a global economy. It's been an unprecedented acceleration of global trade and technology and commerce that has really driven most of the impact we've seen around the planet in the last 50 years or so. And I find it really remarkable to think about this, but when you think of the last 50 years, our population roughly doubled, but the economy, adjusted for inflation, et cetera, increased roughly sixfold. And with that came a tripling of global food demand, a near doubling of global water use, and about a tripling of global fossil fuel use in only 50 years. And what's really remarkable about that is we've changed more as a species and as a civilization than all previous human history combined. All 6 million years of hominid evolution. We've outdone that in only 50 years. And part of that has resulted in changes in Earth's climate. You all know about that. I don't have to give you the whole big kind of background on what causes climate change, other than just to remember that increasing levels of greenhouse gases like CO2, though that's not the only one, have driven most of what we've been seeing. Greenhouse gas levels have increased, in this case, CO2 by about 50% since the 1850s, which is really pretty remarkable. And as a result of that, of course, the planet is warming up. Earth has warmed a little over 1 degree Celsius during that same time period. This is a remarkable change in that we now have a planet with higher greenhouse gas levels and warmer temperatures than we've seen in probably 3 to 5 million years. And that's extraordinary. So what's going to happen next? What are we going to do about the future of climate change? Well, that's still up to us. While the warming we've had so far is basically locked in, what happens next is still our decision. How do we affect the future of climate? Is it going to get a lot worse or just a little bit worse? That's still up to us. And it's really up to this choice here. This shows the history of greenhouse gas levels in the atmosphere. This is the gas itself in the air. And we have a choice to make. We can continue to see that increase going up and up and up. And as those gases build up, the planet warms up, we get a warmer planet, but also more importantly, destabilize patterns of weather and climate, impacts to agriculture, water, health, the economy, security, and so on. Or we could choose a different path. We could do something else where we bend the curve. Just like we try to do with pandemics, we need to do this with the atmosphere as well. And when we get to this point, this blue dot, that's the moment we stabilize greenhouse gas levels and maybe even begin to lower them into the future. And that is the moment we call drawdown. Drawdown is actually a point in time. It's that point in time in the future when greenhouse gas levels stop climbing, they stabilize, and we start them on a slow path of decline. And that's where we stop future climate change. But to do that, we have to start with a little bit of the science of knowing where we need to focus. And so what I want to do in the next 2 minutes is really give you some of the scientific principles we need to be keeping in mind as we think as investors or decision makers of any kind of where best to put our efforts to stop climate change. Well, one of the things we have to know is where are these gases coming from? A lot of people, of course, know that the bulk of them are CO2 resulting from the combustion of fossil fuels, but it's only about 60% of what causes climate change. Even if we could wipe out fossil fuels, we'd still have 40% of climate change left to deal with. So it's more than just the fossil fuel part of the equation, although that is the biggest part. It's not the only part. We also have CO2 emitted from the chemistry of cement. When we make concrete, CO2 outgasses to the atmosphere without fossil fuels, just from chemistry. A huge emitter of greenhouse gases is also deforestation and land use. Burning trees is kind of like burning coal. They both result in CO2 going into the air. And that's about 11% of global emissions, and it's going back up again. The United States, by comparison, is about 12% of global emissions and going down. So that just deforestation alone would be the equivalent of like the entire United States emissions. We also have methane, another important greenhouse gas that comes partly from the energy industry. Methane is natural gas. So when we have fugitive emissions, leaks, and so on, that's a big part of it. But most of the methane comes from agriculture, primarily from livestock. So we have to think both about food and energy in this place. We also have another greenhouse gas you don't hear about very much, but it's huge, 6%, like half the US emissions, is nitrous oxide. N2O mainly comes from agriculture when we overuse fertilizers and manure in farm fields. Some of the nitrogen in the fertilizer volatilizes into the atmosphere, adding to the greenhouse warming. A last area is called fluorinated gases, or F gases, which is right now about 2% of greenhouse gas emissions concern. But that will go up as more and more people are using refrigerants, air conditioners, and so on, as much of the world is getting to that point of wealth where they're buying first air conditioners, refrigerators, and freezers. And so we need to pay attention to that as well. Bottom line is we have to focus not only on energy, but we have to think about land use and agriculture, all those green areas, and some advanced materials and things like concrete and refrigerants. So it's a multidimensional problem with a lot of different places to intervene. And maybe most importantly is we have to understand how the atmosphere works. If we take all of those gases and say, where are they coming from on the left here, I've redrawn those kind of chemical-based graphs from before into now economic terms. These are the economic activities that release those greenhouse gases. So you see words like electricity and food and industry and so on. We'll go through those in a minute. But there's the emissions of our greenhouse gases, what we need to stop releasing into the atmosphere. But the atmosphere isn't sitting still just waiting for us to pollute it. It's also doing its own thing with chemistry and physics and a lot of biology. In fact, right now, about 40% of our emissions are naturally being removed by forest and oceans. Humans aren't doing any of this, by the way. Even if we can multiply our current carbon removal technology by a factor of 1,000,000, it would still be too small to be seen on this graph. Nature is doing all that work, not us. So we need to be very careful here and think about not only our pollution, but also the role of nature in removing some of those greenhouse gas emissions, the so-called carbon sinks that nature provides. What this does, though, is we put in about 100 units of pollution. Nature removes about 40 to 41 of them each year, and it leaves behind roughly 60 or 59% of that into the atmosphere. And that's what's building up year over year for year. But if it weren't for nature, climate change would be a lot worse than it is already today. So to achieve drawdown, to stop climate change, we've got to work on two sides of the equation. First and foremost, of course, is stop pollution from its source, reduce the sources to zero, not net zero, zero, zero. That's where we ultimately have to go. On the right-hand side, we also have to preserve nature because nature is removing some of these emissions. Interestingly, though, what nature removes is in proportion to the emissions themselves. So as emissions go down, the sinks go down too, because they're driven by the imbalance of the atmosphere growing in CO2 concentrations. So we can't rely on sinks being there forever, but we need to maintain them as long as possible while we're reducing sources. There's also, and I'll talk about this later, a lot of interest in artificial carbon removal, but again, it's at least 1,000,000 times too small to even be measurable in the atmosphere, let alone any real help in the near term for climate change. So in the near term, most of the work is going to be reducing emissions, period, and protecting nature. So that's where Drawdown focuses. It looks at near-term, what are available today solutions to address climate change. Yes, we'll need other solutions in the future, and they'll be welcome, but we also have to get started now. So we tend to focus on what can be done today in terms of reducing emissions, for example. Well, a quarter of the emissions we have to worry about are coming from electricity production, burning coal and natural gas to produce electricity. We know about that. But interestingly, food is equal to the electricity sector in terms of global greenhouse gas emissions, yet it gets maybe 1/100th the same amount of attention from policymakers and investors and philanthropists. So we need a major focus on food, land use, and agriculture because it's the second largest and tied roughly with the number one emitter of greenhouse gases, electricity. Isn't that weird that making electricity and making food is half of climate change and they're roughly equal? All industries together, about 20% of climate change there. Transportation is about 14%. Buildings directly add another 6%, but buildings also use a lot of the electricity that's produced and are using a lot of the materials made in industry. Also, how we build things drives a lot of our transportation decisions. So the built environment is also a big part of what's going on here. And then everything else, the last 10%, are things mainly found in the energy sector, like fugitive emissions, refining oil, and so on. But the first 5 are interesting. Electricity, food, industry, transport, and buildings are 90% of climate change in only 5 big areas. So let's look at them. Well, in Drawdown, we look at each area and ask the question, how can we reduce emissions in electricity? One way to do that, of course, is make electricity differently. But the other way to do that is use less electricity overall by being more efficient. So we tend to look at solutions that combine both efficiency in electricity, using less, and then shifting production by making it in different ways. These circles represent our kind of current assessment of what climate solutions are available now to reduce emissions from electricity. The bigger the circle, the bigger the solution could be. And what we see here is a combination of some very good efficiency measures that pay for themselves immediately and are available right here, right now, plus a shift in infrastructure away from, let's say, gas and coal towards more renewables like solar, wind, et cetera, but including other things like nuclear, ocean power, and so on, could make a huge difference. In the food sector, we have to look primarily at the things that really cause emissions in food, and they're primarily deforestation, clearing land to grow more food, methane, mostly from cattle and sheep, and then third, nitrous oxide from overusing fertilizers and manure. Those are the 3 big emitters in the food sector we have to be playing with. To do that, we also can look at things like efficiency, reducing food waste, which is about 40% of all the food grown on the planet is thrown away. That's incredible. That means 40% of the land, the water, the greenhouse gases, and everything wasn't really even needed. On top of that is also shifting to more plant-based diets, not necessarily everywhere and everyone, but especially rich countries that already have good diet availability. Shifting to a little more plant-rich diets can make a considerable difference, both in reducing emissions, but also sparing land that can absorb more carbon. We also need to protect ecosystems from being cleared. Stopping deforestation is probably the #1 climate solution, period, in terms of speed and scale. But also shifting the way we farm. You'll hear a lot of excitement around regenerative agriculture that can both reduce emissions, but also maybe build carbon back in the soil long term. We also can look at the breakdown of what causes emissions in industry. We have things like metals, especially steel production is very important here. Cement is very important here. Chemicals, including all plastics. Plastic currently is about 1 to 1.3% of what drives global emissions, but that number is increasing and also has other important environmental impacts. Also processing our waste, whether it's water waste or solid municipal waste, et cetera. Transportation is also critical. Mostly it's road transportation. 14% is from transport, 10 of that is on roads. Flying is also important, about 2%, and then rail and boat and everything else is the remaining 2%. Buildings, again, directly from the furnaces, boilers, hot water heaters, and so on in the buildings, produce 6% of emissions on top of the electricity and materials they consume. Most of that's in the residential sector. And so we have to think very hard about how we power, cool, and heat buildings and so on in this space. Things like heat pumps will be particularly important here. So those are the different areas where we can do analyses to show which climate solutions are available now and which ones are really worth investing in terms of bringing them to scale. We also have to, though, support the natural carbon sinks of the planet. You might call this carbon removal by nature. And again, the point here is nature is doing all of this to, the human efforts over the last 50 years, and we've been at it for 50 years, still are about 1/1,000,000 of 1% of what we need to do to address climate change. So right now it's just nature, and that means forest, and that means coastal oceans. Those areas must be healthy. They must be not cleared, not further degraded in order for those things to still be doing what they do and removing about 40% of our current pollution levels. Down the road, but it may be 20 to 30 years from now, but maybe sooner, engineered sinks, direct air capture, carbon capture, and storage. We have been working on these things since the 1970s, back when it was called clean coal and other things. hasn't really made a lot of breakthroughs yet, in my view, in terms of the scale we need. But there are a lot of smart people working on this, and hopefully that will take off too. But again, for now, it's mostly nature. The big picture here, though, is we have to reduce sources here in electricity, in food, and industry, transport, buildings. These are the big opportunity spaces in the different sectors. And frankly, we haven't done a very good job of aligning our money or our policies or actions to what the science says. We've put a lot in electricity, but then ignored a few other sectors, is just one example. So if we want to align our investing, we have to align it with what the atmosphere needs and where the opportunities are. And that's what this map can give you some guidance on. We also can look at ways of supporting sinks on land, both in nature and then maybe additional sinks in agriculture and forestry. The good news, though, is that when we do this, if we deployed solutions available today, we still have a chance to bend the curve on climate change and bend it a lot. The red curve is probably our best guess right now what climate change would do based on current levels of policy and action. That red curve, by the way, has already bent somewhat. It used to be we'd be thinking about 4 or 5 degrees warming. Now it's maybe 2.5 to 2.7. But we need to get down to 2 degrees or less. That's what the Paris Accords say we need to do. And at Drawdown, we believe we still can bend the curve to arrive at either 2 degrees or somewhere between 2 degrees and 1.5 degrees of warming is still possible. What we've learned so far from all this is, first, we do have solutions to stop climate change. And right now, we even have enough to do the job, but we could use more. More solutions and better solutions and cheaper solutions and more scalable solutions would help a lot. We also need to make sure these solutions help the world in other ways, whether it's by creating jobs or addressing issues of equity and justice or helping with biodiversity and water and health and other things. So we want to have multidimensional solutions that don't just fix the air, they help us build a better world. But where do we invest? I hope we have a great conversation around this later today in the session, but where can investors really help out a lot? Well, again, some basic principles really need to be kept in mind. And to be honest, I don't see the investment community doing this very well sometimes. I mentioned one first is align your dollars with the gigatons. Right now, there's almost no alignment with where dollars of investment are going to where the gigatons in the atmosphere can be reduced. That's huge. Please align money with physics. Then we actually have a chance of getting somewhere. One of the other things we have to keep in mind is for the next 10 to 20 years, at least 90 to 95% of all the work we need to do is in cutting emissions. And that's going to be far outstripping any attempts to remove carbon from the atmosphere, which might come in later. In fact, this graph tells us what we really need to do. The red curve is the rise of greenhouse gas emissions, and that big red dot at the top is where we are today. To keep us below 2 degrees, maybe 2 to 1.5 degrees of warming, we basically have to cut emissions in half in the next decade or so, and then cut them in half again and half again until 2050 or so. At present, we also need to add some carbon removal because it's unlikely we can stop all greenhouse gas emissions. But for the last 50 years, all carbon removal efforts have amounted to absolutely zero. No carbon has been removed that can be measured in the atmosphere yet. It's going to take us decades to let that scale up. And right now, it'll probably be the 2040s before we can imagine any of that really biting into the atmosphere and then taking hold by the 2050s. That's where we get to net zero, but most of the net zero is just plain zero. So 95% of this is going to be just cutting emissions. So let's do that. We also have to make sure we're working not only at the scale we need in the sectors we need, we have to work at the speed we need and recognize that different climate solutions operate at fundamentally different kinds of timescales. If we need to cut emissions in half, like right now, we need some quick wins that can be deployed today. Not big things that take 10 years, 20 years, arguing in the Senate, building things that take 20 years to get out there. We need some things that can cut emissions by a quarter in 5 years and in half in 10. Well, what are those kinds of things? Well, they're going to be stopping methane leaks, stopping deforestation, huge improvements of energy efficiency, et cetera. Things where we can flip a switch and stop doing dumb things. I would put stopping deforestation and fugitive methane emissions as the number one and number two kind of quick wins we absolutely need to buy time. We also need simultaneously with this, in parallel, is to rebuild the world's infrastructure, how we produce electricity, how we do transportation, how we grow our food, everything, all the buildings in the world, everything will have to be updated. And even if we could throw trillions of dollars at that today, that's still decades of work. Even if the speed China is doing infrastructure, it's decades of work. So we need to have quick wins now while we can buy some time while starting this long and big process of rebuilding the planet's infrastructure. Those have to be done in parallel. We can also grow some of those natural sinks. We can build soil, we can plant trees, but the trees we plant today absorb carbon basically 30 years from now, mostly. Same with soils. Those take decades to build up those carbon sinks. They're not instantaneous. So let's start planting the trees and building the soil today, knowing they'll pay off in the 2040s and 50s. And then we have the new technologies, things that aren't even on anything but a bench right now. How do we get them to scale in the global economy really fast, but knowing that it may take some time for that to happen? So we need multiple waves of climate action, and I think we need investments in all four of these categories, not just one. And we need to make sure when we pull the levers of investment, putting capital into solutions so they scale, which is critically needed, let's make sure that when we do that, we're also looking at other levers we can affect, whether it's changing policy, changing the practices of business, changing the kind of tenor and tone and focus of where technology is really going, from being kind of starry-eyed tech to more practical near-term things that can really work, but also things in culture and behavior. We're going to have to change the way we think about things as well. But the ultimate thing here is if we can pull multiple levers in the right sectors at the right temporal scales with the right kinds of solutions, we get to reimagine the world, and we get to build a better one where we stop climate change, but we also can make a lot of other things better. And I just want to end on this little, maybe more hopeful note. When we talk about kind of a grim topic, it's important to remind ourselves that the future is always up for grabs. And it belongs to the people who take some risk, but also accept the responsibility of consciously creating a future that they want. So with that, I will stop here, and looking forward to continued conversation through the hour here.
Thank you very much, Jon. That was a really useful primer. I really like the Project Drawdown framework for investors, because I think it's a useful way of conceptualizing what are the things we need to fund, and how do we get to where we need to go. So the rest of the work that we're doing with Project Drawdown is really going to focus on what are the investable solutions and how do we get capital into them. Our next session is going to focus on managers that are offering these solutions. And we have a call for nominations out there for fund managers who align with the Project Drawdown solutions. So if you have good managers, please nominate them. Now I'm excited to introduce Jamie Beck Alexander, the Director of Drawdown Labs, and our esteemed panelists. And thank you again to all of our speakers. Jamie, please take it away.
Wonderful. Thank you, Imogen. Thank you, Alyssa, for hosting us today. And thank you, Jon, for that powerful overview of the solutions, the tools, practices, and technologies that we already have in hand today to address the climate crisis. I'm Jamie Alexander. I'm Director of Drawdown Labs at Project Drawdown. Drawdown Labs is the part of the organization where we work with companies, investors, and philanthropy to help them understand where to focus to deploy their resources and capital for climate solutions. So we know we need to move a lot of money to climate solutions, and as Jon said, aligning our money with what the atmosphere needs. So we are going to turn to an amazing panel with 4 leaders in climate investing from across different types of capital allocation to really try to understand how for-profit capital can play the very significant role that we need it to finance the world's pursuit of drawdown. So I would love to have the 4 of you each introduce yourselves. So you know a little bit about yourself, your work, your type of capital allocation, and how familiar you are with investing climate solutions or the drawdown framework. So Anna, I'll turn it over to you first.
Sure, thanks. Hi, Anna Totdahl. I am the investment officer for ESG and sustainability for the Oregon State Treasury. We manage a little over $100 billion on behalf of predominantly the retirement plan supporting the state employees. And so I've been in this role for about 3.5 years now, and I am responsible for all aspects of ESG. But I think most sort of resonant with this panel is we've recently undertaken a climate analysis. We've engaged a climate consultant to do a review of our portfolio to analyze what might be the financial impacts of climate change on our investment portfolio. So we're in the midst of that now, and looking forward to seeing the results.
Great, thank you, Anna. And we'll go to Yana next.
Thank you. And thank you for having me. It's great to be part of this conversation today. My name is Yana Kakar, and for the last 10 plus 15 years, I've been doing sustainable business advisory and sustainable investing. And most recently with Dalberg, which is an advisory firm that does that work. And then in the last just few weeks, I've launched a new public company called Growth for Good. And Growth for Good is a sustainability acquisition corporation, otherwise known as a SPAC. We're a $250 million SPAC. And our goal really is to find a private company that is in this space, has a disruptive and innovative business model that is seeking to shake up the high carbon sectors in our world and help us accelerate towards a net zero transition. So it's a pleasure to be here and to be speaking with all of you today.
Thank you so much, Yana. And Amanda, do you go next?
Thanks, Jamie. I'm Amanda. I'm with Treehouse Investments. We're a family office. So we actually started out as a family business in 2007, developing and operating wind projects, and found that was a slower process than we'd anticipated. And in 2013, we set up the Treehouse Investments as a fund to invest across asset classes, specifically in climate-focused infrastructure. So we're looking at energy, water, and waste, and looking at solutions that are available now to scale up, and not so much the kind of moonshot type of thing, but actual like current earth shot more kind of idea. So have been very interested in the Drawdown project since we first learned of it.
Thanks, Anna Amanda. It's great to have you with us. And lastly, Bradley Palmer.
Yes, hi everyone. I'm Bradley Palmer. I'm chair of Project Drawdown, so I'm lucky I get to work with Jamie and Jon Foley and their incredible team at Drawdown. In my day job, I run my own family office, which is called Palm Ventures. And over more than 20 years, I've been an entrepreneur, starting companies and buying control of companies, 65 companies over the years, all in the impact space in various sectors. And about 10 years ago, I turned my business into a family office. And in terms of climate and sustainability, our investments, because we're not a gigantic family office in the billions, we're not looking at institutional type investments. We're focused on more in a deep tech space where small dollars can produce big results, potentially. High risk, high return. We've invested mostly through seed stage venture funds to get at these deep tech investments, and we do some one-offs as well. And I'm pleased to be here today. I think it's great, the forum you're hosting. And look, I think it's interesting to note that when we look at the climate issues and who's making progress, it's actually the private sector, family offices, private endowments, and big corporations that are moving the needle the fastest. Governments are moving slower. And so I think putting capital to work and accelerating drawdown type solutions is moving the needle. Thank you.
Thank you so much, Bradley. It's so great to have you with us. So we are going to dive in a little bit more deeply now. And Brad, I want to stay with you for our first question. So you've been the board chair of Project Drawdown for several years now. And you're, committed, as you said, to investing in climate solutions through your own family office. So I'd love for you to share a bit about what drew you to the Drawdown solutions, and what kind of made you value Drawdown as an organization that you put your time and resources into.
Thanks. I've been chair for 3 years, and I've seen under Jon Foley and the team tremendous growth from what was a small organization more than 3 years ago, which really was an organization that published a very important piece of work, the Drawdown book, which became a New York Times bestseller. That caught my attention. And the models and the data behind that work. And what I was attracted to, because I'm a business person, I'm an entrepreneur, is the Drawdown was taking the approach and changing the conversation going back 6-7 years ago to, rather than doomsday, a discussion that said, we have the solutions today. And if we invest in these solutions at scale globally, we can reach Drawdown in 30 or so years. And that was, Drawdown was really the fresh voice that I think helped pivot the conversation to a more constructive one, a solutions-oriented one. And I also was attracted to Drawdown because most of the solutions are very basic solutions that are not super high tech. Jon mentioned many of them. They're practical solutions that if people have the will, if governments, if companies, if nonprofits and so on have the will, these solutions are available today. So that's what drew me to Drawdown. It was practical, it was actionable, and involved the private sector putting capital to work, generating actual returns, and changing the curve on climate.
Great, thanks. And one follow-up question. So coming from a family office perspective, what do you think needs to be done to get more funds allocated to climate solutions? What are the changes that you think need to happen?
Well, it's something that Jon and I talk about on our weekly calls, and Jon really gets it, I think. And that is that, look, the largest family offices in the world, and let's say the large family foundations, they have the data, they have experts on staff, and I think they're doing good things. Maybe that represents 5% of the family offices globally that have the teams in place. They're multi-billion-dollar family offices or family foundations. Sometimes they're both. They're affiliated, a family office with a large foundation. It's the other 90% of family wealth, family offices that don't have the education, they don't have the teams, and frankly, they don't have the deal flow. They don't have access to the opportunities. And that's what we at Drawdown and others, like High Water Women, can help change, educate, and provide opportunities to these pools of capital that want to do something. I think that the other thing I would just say is that I talk to a lot of family offices. I'm involved with 3 family office organizations. And, it's the millennials coming up in these families that are putting huge pressure on the elders in these family offices and foundations to allocate money around sustainability and climate solutions. And so, they need education, they need support, and they need deal flow.
Yeah, thank you, Brad. And I want to come back to that topic of deal flow. But first, I want to turn to Anne Amanda. I understand, Anne Amanda, that your family office, studies the impact of climate solutions, at least partially based on Project Drawdown's framework. So I'd love for you to describe, what do the different solutions mean to your team, and how do you sort of make decisions about investment opportunities in your portfolio?
Yeah, it's interesting because it comes up and there's a question I see in the chat from Suzanne Beagle about the gender aspect of drawdown, which I think was something that I was going to bring up as well. It's like so we're particularly interested in greenhouse gas reduction and in gender equality and in getting a good return on our investment. Those are kind of our three, getting a good financial return on our investment. So those are our three core areas. And one of the things that really stood out in Drawdown was that it had some of these social aspects as well. There has been, and I'm happy to say, I think it's reducing significantly, and ties into what Brad was saying about the millennials coming in. I think it also ties into a lot of women coming into asset ownership on the personal and family level. That there are these other factors that are being brought into the decision making, and the drawdowns focus on things that went beyond just technical fixes. And by technical, I mean, everything is kind of a technical fix, depending on how you look at it and how broadly you describe technical, but that we're not just engineering solutions, but that are broader considerations. And so particularly the girls' education was one that I thought was really striking, that girls' education and family planning together were the single most effective thing that you could do, or that most value for money, if you want, in terms of reducing climate change. And the other one that I remember that was in there that isn't as explicitly gender, but I think has many gender connections, is smallholder farmers. And I think for our perspective, we were always involved with a lot of impact investing type of groups, small family offices and investors that have interest in impact. And we're always kind of trying to understand why more people weren't investing in climate, like why they weren't seeing climate as an impact, as a social impact. And there seemed to be a bit of a split between the environmental, well, kind of the climate and energy people, and the impact, the more social impact. And from our perspective, I mean, climate change is going to wipe out anything that you care about. So if you care about girls' education and we're not addressing climate change, your money is going to lose value. It's functionally climate change, even before the past couple of years, when it's become clear that it's much more present than we allowed ourselves to believe a little while ago. That even without that, it's gonna functionally have a deflationary effect on your money. Because if I am investing in literacy, but the school can't operate because the power has been knocked out by another storm, then I need to address this, and trying to communicate the need to address this with other investors in a way that would draw others into a climate focus, I think was really for us how Drawdown really helped. We are relatively specialists in a few fields we're very happy, actively involved or actively aligned with Drawdown, specifically energy, generation and waste management, basically. So reducing methane from food waste, and then looking at everything through a gender lens. We're trying to. But the beauty for me is that it's really open to anybody who's interested in including social and environmental considerations in their investments. Suddenly you can do this even if you're not an expert in energy generation. You don't feel like you have the knowledge to invest in this, but you care a lot about food and agriculture and smallholder farmers was suddenly you can start looking at your food and agriculture holdings through a lens of how that impacts climate, and not just through a risk assessment, but through a positive impact. How can we actually contribute to the solution rather than just trying to mitigate the dangers of supply chain because everything's going to be underwater? I think I went a little off, but
yeah. Thank you so much, Anna. I think that I love what you said about, climate change is sort of affecting all of the things we care about and all of our investment decisions. And I'm curious if you could just elaborate a bit on what do you think has contributed to your success the most when integrating climate solutions into your investment decisions? Is it sort of the educating your staff around climate change, or investment committee members, or advising portfolio companies? What are some tips that you would have for how you've been successful in integrating climate?
That's a really interesting question. I think more than anything, what has been challenging for me personally, maybe more than for the group as a whole, but for me within our role, is being willing to be annoying about it, to understand that I have this topic that's a bit of an idée fixe and has always been, or has been for us since is a foundational issue. And so then we will find an investment that's a good investment that is strong in climate, but maybe not climate focused in their own minds. And how do we get them to start to add that? And similar for gender, like how do we get them, if it's an all male team, they want women involved, but they don't necessarily know how to do it. And it's an all male team. And so that's a second tier thing. And climate has been that for many investments as well. And including we have public equity investments. So, engaging with management there and being willing to bring it up again. And what's been most interesting to me about that, which is a real challenge for me, like I really don't like to annoy people, or I'm sure, or at least not knowingly. But what has been particularly interesting to me and empowering and kind of motivating is that many of these, then a year later, 2 years later, they come back and they're starting to answer the questions, which is fair because nobody has the answer the first time they're asked a question. I don't know how you do this, but then you think about it. And if it matters and enough people ask you, you go back and you look. And so I think for me, it's the willingness to ask the annoying question, which soon becomes the standard question. And then once it's a standard question, everybody's proud to be able to say, and this is what we're doing about, and then they look good and they're happy that you pestered them about it.
Yeah, thanks so much for that. And Anna, I would love to turn to you now. As one of the institutional investors on this panel at Oregon State Treasury. You represent one of the country's most extensive public pension plans. What parts of either the drawdown framework or climate solutions in general, do you think resonate with institutional investors, if any? And what are some barriers that you see to adoption for large asset owners like pension plans?
Yeah, I think what resonates to institutional investors is the same as what resonates to us simply as human beings. It's the idea of there being a roadmap directing investments towards the greatest global needs and leading to a solution to the climate crisis. Some of the barriers that come into play, particularly for pension plans, is first and foremost the idea of fiduciary duty. This is what you'll hear brought up each time any concept of impact investing or socially oriented investing comes up. We're required to take into account only the financial impact of an investment. It has to be ex ante, from a return perspective, better than the next best alternative. And I know it's tough to say, and particularly with these new types of investments that folks haven't seen before, it's hard to say that we expect these to perform better than the sort of tried and true things that we're used to. And so that's probably the biggest hindrance, is just having to take that into account. So for example, there are sustainable development goals that might be important to society overall, but may not be financeable or contributing to a market rate of return. And that's what we have to look at, is the market rate of return from a long-term perspective. So yeah, I'd say that's sort of the biggest initial barrier.
Great, thank you. And then a follow-up question for you, Anna. Where do you see the most interest from institutional asset owners when it comes to, focusing on climate-related investment opportunities? And do you see a disconnect between anticipated investment returns and impact on greenhouse gas emissions?
Yeah, so I think for institutional asset owners, it's still early days. It's early days, but I feel like the pendulum is swinging more quickly. I would say maybe 5 to 10 years ago, the idea was to think about stranded assets and what is our stranded asset risk. And then the conversation sort of moved towards portfolio carbon footprinting and what is the footprint of our portfolio. And now I think the conversation is moving more towards the sort of econometric analyses, so much more forward-looking analysis of what's going on in the portfolio and what's going on with respect to climate and what's the intersection there. So that's sort of what led to us engaging a climate consultant to do a review of our portfolio to sort of get that forward-looking view. But I think also one of the issues that we have as a large institutional investor is the scale and the construct of the investments. So for us, to keep the volume of managers that we invest with to a manageable number, we need our investments to be rather large. So it's sort of perverse problem to have. Like we need to be able to direct lots and lots of money. But we're talking single investments with a manager in sort of the hundreds of millions of dollars range. So though it might be counterintuitive, that automatically excludes a whole slew of otherwise attractive investment opportunities. So, and then regarding the construct, there really needs to be sort of a three-dimensional Venn diagram that overlays the academic wisdom with what's actionable and investable, and then developing that into an investment product. So there are investors with different risk appetites who want to play in different levels of the capital structure. And so, some might be interested in taking the equity position, but others might want a more sort of debt-like instrument. And a lot of these deals can run the gamut, but you need to sort of structure them all to be attractive to different investment types or investor types.
Fantastic. Thank you, Anna. And Yana, it looked like a lot of what Anna just said resonated with you as well. You do a lot of work with asset owners and fund managers, and I'm curious to hear your perspective on how a climate solutions framework can resonate or not with asset allocators, and how we might be able to translate the thinking that Jon, and the climate solutions and resources that Jon described earlier into a set of actionable activities for asset allocators.
Yeah, I mean, what Jon and his team have created, and what Brad chairs, what Project Drawdown provides us is, I think, what is deeply needed. It is this neutral, objective, evidence-based, data-driven, not pushed by politics on one side or the other, line of sight into where are the greatest needs and what are the solutions that could address those needs. Now after, a couple of decades of working with, whether it's capital allocators, be they, pension funds, sovereign wealth funds, so on and so forth, or actually the asset managers and the fund managers themselves. What I find is it's finding a way to put an economic overlay on top of the academic truths, because it's not a perfect, there's a Venn diagram, there's a strong Venn diagram, but it's not a perfect overlap. And so, what Anna said really caught my ear a moment ago. She said, look, it's about fiduciary duty. And so if you're engaging in a conversation, you say, look, here's where integrating these, these investment, here's why these investment opportunities actually meet your fiduciary requirements, because they're the ways in which you can risk manage portfolios for the future. Well, then you're talking a language that, sort of Anna's key stakeholders and shareholders and others, that'll resonate, that makes sense. And I think as I look at where I imagine us taking this next, it's when one is engaging in a conversation, say with not even just an allocator, of course, but let's say with a private equity, fund, and saying, look, there's money to be made here, and here's where the needs are. It's recognizing and approaching that conversation with language and framing, that both sides of the table can understand. And certainly, if I think about a private equity conversation, one of the things I often touch on is time frame, right? There may be an enormous need in infrastructure, but I know that may or may not meet your time frame, depending what that is. And so I think that's basically, it's sort of almost as simple as that. What Project Drawdown provides us is a resource to draw from, and it's incumbent upon us, I think, to translate what it is telling us into terms that will resonate with the needs and the preferences of the people, whether they be capital allocators, owners, managers, that we need to influence their choices.
That's a really, really helpful perspective. I really appreciate that insight as we look at, how we can start to make this information more useful to this community. So I want to touch on something that Anne and Amanda earlier had referenced, the importance of the women and girls and access to health and education. I would love to hear, Yana, thoughts that you have there about how we can get, institutional investment councils to care about, women's rights in their investment portfolio, and how we can kind of close that gap.
Well, I look at this from two perspectives. One is there are going to be areas of need that won't necessarily be investable opportunities. I draw a distinction between where do we need financing and where is there an investable opportunity. Those are two different questions. Those are two different things. And, there are very real and meaningful needs for financing to issues related to women and girls, maternal health and mortality, you name it, girls' education, and they may or may not be investable opportunities, and that's okay. And it's incumbent on us to filter accordingly. But the second perspective that I see this through is any investment has been, it literally has been statistically proven time and time again, when you apply a gender lens, if you will, to that investment, when you look at it through through the filter of, let me not assume that that women and men consumers are identical, or women and men recipients are identical. If you apply a gender filter, a gender lens to any given investment, whether it is, where should I put my, this investment in a wind farm, or whether, where is it that I should make another climate tech, investment bet? If you account for gender in that equation, you make a smarter investment. because much like it's a component of S, frankly, how is component of G? It's about just incorporating the factors that are in fact material to your investment into the return.
Yeah, thank you so much, Yana. I think that's really important. And I also really appreciate not everything is going to be an investable opportunity. I think those are really important points. So I want to circle back on this question that I think Brad first raised around deal flow. Brad, you mentioned the lack of, kind of high quality deal flow for, for investable climate solutions. And I'm curious if you could talk a little bit more about that and why you think that is, and what you see sort of on the horizon there.
Well, I think part of it is just the big check sizes that are needed in these large institutional type raises that are for wind farms, are for hydro, are for solar, very large solar installations and others. And my family office, just doesn't make those kind of investments. First off, we're looking for returns because our AUM is in the plus 100 million range and less than 500 million. It's not writing, 10, 20, 30, $50 million checks like the state of Oregon is. And I applaud them for that. And by the way, the state pension fund of Oregon has been one of the most progressive investors going back to the early 80s, which is why you have such a big amount of capital under management and are so fully funded today. Because you were so progressive in the early 80s, investing in private equity firms when no one else was, and so on. So I'm very impressed with what Oregon has done. But look, I'm putting my capital. I think the elephant in the room that nobody's talking about, and we can talk about gender all day long, and I'm as big a proponent of women leaders and women taking charge and equal rights and all of those things. But I'm sorry, the clock is ticking really fast right now. And we're probably not going to move the needle quick enough focusing on gender issues if what we're talking about right now is climate. Climate change is happening exponentially. Humans are moving in a linear way, in my opinion. I'm not speaking for Drawdown here. I'm giving my own personal opinion from my family office point of view. And we're just not moving fast enough. And that's why I think Jon was correct in saying we need to focus on the low-hanging fruit. And he identified deforestation and the inadvertent release of methane from well sites and other things. We need to get capital and people focused on projects that can have an immediate impact. Because as I said, climate change is moving exponentially. Humans are moving in a linear way. These lines are not intersecting. We're not getting the job done. And so for my family office, and I'm sorry, I'm going off a little here. I'm looking for investments where my capital can have a multiplier effect. And so I'm looking more in deep tech because I think that's where we need some big breakthroughs. I was very impressed and applauded Elon Musk, and not everyone agrees with this. Elon Musk put up $100 million X Prize recently in the last few months through the X Prize Foundation for carbon capture. Now, it's very debatable whether there will be sound economics behind systems and equipment to do carbon capture out of the air. But I applaud him for putting a huge prize out there. And maybe somebody on this call, or maybe people in the High Water Women group want to contribute to that prize. Because if someone could make a breakthrough there, if it's possible, and we don't know what's possible until we put the money to it behind smart people, that's the kind of thing that can move the needle. So final sentence is simply that I would encourage the smaller and mid-sized family offices to look at venture funds that are doing deep tech and tech investing on things that can really move the needle in the near term. That's my view.
Thanks so much, Brad. Does anyone want to jump in on that question around deal flow, around the kind of laser focus on emissions and gender? Anyone want to jump in there? Yana?
Actually, I just want to say a quick one. I think what Brad said about the differential sizes of the check is really important, and it points us towards what many people may have already heard of, but perhaps some not, which is blended finance. And this is where, you know, you get smart about how do you use philanthropic capital to come in alongside public capital and alongside private capital, so that you can create the conditions where different sized checks and different sized, sort of different investors with different objectives can combine their capital, blend their capital in a way that makes the investments that we need to make sense. I was, until very recently, on the board of an organization called Convergence Finance. It's a nonprofit out of Toronto, run by a terrific person, Joan Larea. And that's what Convergence does. It's sort of like an online marketplace, if you will. I used to joke it was the Match.com of blended finance, but that's because I'm old. I don't even know if that exists anymore. I was probably so out of date. But where it's bringing like really smart deals that are aligned to the Sustainable Development Goals, and saying, hey, I'm so and so private investor, philanthropic or public, but I need $3 million from somebody that's not too fussed about returns, and this one needs $50 million from somebody who is fussed about returns, and you end up creating a stacked or tranched investment proposition that can make a real difference. I just thought I'd check that out there.
Yeah, thank you so much, Yana. Any other thoughts on deal flow or where or anything else, Anne and Amanda?
Yeah, it's interesting to hear Brad's perspective on it, because we actually have tons of deal flow. Like I have always, it seems like, more than I can manage. And we specifically invest a lot in sub-Saharan Africa. So I think it may be partly to do with where you're looking in terms of what the need is, because in sub-Saharan Africa, and I think in some other emerging markets, there is tons to be done, and all of it can have a significant climate impact. And one company that we're invested in right now, called Cocoa Networks, it's an all-male team, but they're in cook stoves. So they do energy. They're actually a tech company. They have a platform that is a distribution of ethanol for cook stoves, and so they source the ethanol and they have it distributed, and they have set it up so that they have the local shop owners who are involved in the, sorry, I'm mangling this, but so the shop owners are connected into they get paid by cocoa for the sales of ethanol within their shop, and all of that is IoT and distributed. But the problem that I see, and one of the most interesting things about it, is that it's actually a deforestation from a climate perspective. The big thing that they do is reduce deforestation. They reduce charcoal use, kerosene use in homes for cooking, and as a result, that has the capability of significantly impacting deforestation in the region, which is the level of deforestation in the region is huge. This is in East Africa and Kenya and surrounding areas. And so they are right now scaling up very fast, but it's taken a long time to get to that. And I think that's the problem with both deforestation and with tech solutions, in my experience, is that at some point, well, deforestation is challenging because it's about human behavior. We don't deforest separate from human behavior. It's all part of how our culture handles its environment and what it's used for, and to what extent we're using it in a sustainable way. And so like you can't tackle deforestation easily with tech. I mean, I have seen companies where drones dropping tree seedlings, and there are attempts, but none of these have yet been able to scale that I've seen. And on the flip side, tech brings a lot of exciting solutions, but at some point it has to be manufactured, it has to be sold to more people, it has to be scaled up. And that usually takes a really long time. And that's why I think the Project Drawdown has been most interesting to me, because it's talking about currently existing solutions that we can roll out and that we can scale up, that are ready to scale now. And so I think from my perspective, I mean, the Cocoa Networks is this one that I think is a very interesting gender perspective, because it's talking about behavior of mostly women in terms of cooking. It has health benefits. And so there are all these synergies when you find the right solutions that come together in ways that can tackle all of these things. And I'm not saying that we need to wait for the perfect solution to solve all of these things, but I think that as we look at individual solutions and try to see how they can also benefit in other ways, and we can add stuff onto them, then they're much more impactful and they're much more likely to draw more investors and scale.
Thanks so much, Amanda. So we have 10 minutes left of this portion. I want to ask Anna a question, and then we'll have one last sort of looking ahead question for everyone. So Anna, what can, when you think about, ESG fund managers, how would you say that, the pitch needs to be improved for institutional allocators, and how do you sort of overcome, hesitance or skepticism from investors over investing in climate solutions?
So I'll be a little bit of a politician here and answer a slightly different question. I remember a conversation I had with a manager once, and I was asking about climate scenario analysis and whether they had looked at that for their portfolio. And the manager was resistant to the concept overall and said to me in a sort of exasperated tone, is it really the responsibility of an equity manager to solve the climate crisis? And I was like, well, yeah, we all have to do our part, right? And you should be thinking about that. So in a roundabout way, I'll say that what managers and we all, and to Amanda's point, this is all related to human behavior. I think this is sort of a twist on the prisoner's dilemma game theory, and I'm not an economist, but this is like, we're all better off if we all take action, but who wants to be the one to take action? Because there's this view that if I let everybody else go first and I hold back, I can sort of lap up all the juicy returns in the meantime, and like I'll jump on the bandwagon at the last possible moment. So I think that's the sort of mindset that's going on here. So I think that we all have to, and I would love for a behavioral economist to sort of study this and tell me how to get all of us to move together. But I think that what we all can do is sort of take responsibility for our own role in finding and making progress towards a solution.
Fantastic, Anna. I love that. Thank you so much. And one last sort of forward-looking question that I want to throw out there for everyone, just sort of, looking ahead, what are some new investment ideas you may be considering going forward, or opportunities you're excited about in this space? Anyone want to jump in first? And Amanda.
I was thinking one of the spaces that we're not very active in, that we're looking at, and I'm quite interested in right now, is waste and waste management, and trying to find ways to make our economy more circular. I think that potentially it ties right into a lot of the efficiency question within Drawdown, but also the yeah, just waste management. I think that's the wave of the future. I'm also a sewage engineer by training, so that might have something to do with it, but
I'll jump in and say pardon.
Please
I'll
go
just
ahead. Please
sure.
go ahead.
No, not at all, Brett. I was just going to say, I think for me, not being a sewage engineer by training, I'm looking at it more from the perspective of almost like sector agnostic, whether it's, and in fact, trying quite hard not to fall in love with a certain sector as I'm prone to. So whether it's mobility and transport, it's energy, what have you, industry, materials. I think that the investment opportunities that I have my eye on is where do you, and not just because, yes, because of the SPAC, but even more broadly, I think where I personally can be most additive is where the companies that are investable opportunities that I can help scale. Everybody is useful at a different inflection point of a company's life cycle. And I think from my perspective, where I can be most useful is, irrespective of sector, find the ones that have really strong business fundamentals. They're on the path for really strong unit economics. I can see that whatever they've got so far is working well. And if they could just, get enough capital to expand their production facilities, or if they could just be able to access lower cost capital and expand into new markets, you could really imagine them getting to scale. So that's how I'm kind of looking at the investable opportunity set.
I'll just add that I really liked what you had to say, Anna, and I applaud you that it is a bit of a prisoner's dilemma. Look, the pension funds and the sovereign funds in the world are managing the most money. And I thought of, while you were speaking about this prisoner's dilemma issue, that most large pools of capital are saying, well, this really isn't our responsibility. We need to go for the juicier returns. And most of the best returns are not in climate, they're in other areas, okay? There are good returns in climate related investments, but the premium returns are still probably in other areas, software, what have you, right? Crypto, I don't know. There are lots of places. I wonder what I thought about while you were speaking, Anna, is that how Oregon has been such a leader, along with some of the Canadian pension funds, which are incredibly well run, right, and have extraordinary returns and yet are progressive. I wonder if there couldn't be a few pension funds like yours that take the lead and challenge the other pension funds, the way some of the billionaires have done, to say to other billionaires, we are encouraging you to commit half of your net worth to philanthropy. There's that club, I forget the name of it, right? And it's a lot of peer pressure, and all the billionaires want to join it, so they're part of the club, right? Why couldn't a small group of pension funds do that? To take the lead and say, we're committing X% of our assets to climate related across the whole spectrum, from early stage, seed stage, maybe that's, 0.25% of your assets go into deep tech and so on, all the way up to wind farms and so on, and challenge other pension funds to follow you and join your club. I like that idea. The final thought I want to say is, I think we need a Manhattan Project around deep tech on climate, like we did during World War II. Look what the US did with the Manhattan Project. It ended the war. You may or may not agree with nuclear weapons, but it ended World War II to a degree, right? And the Manhattan Project was a full-on assault on developing, nuclear. We need something like that. And I kind of wonder if also a group of pension funds couldn't get together and push on the federal government and other pension funds. Let's put some capital around deep tech where we could get a big breakthrough. Those are my thoughts. Thanks.
Brad, I like that idea a lot. Just food for thought. If you ever want to avoid the nuclear thing, another good analogy might be Project Warp Speed, Operation Warp Speed for the vaccine development. Slightly less nuclear.
Yeah, the problem then we've got a reference to Trump, and I don't
There
really
is
like
that.
that one, but,
There is that.
but
yeah.
it is a better analogy. I will acknowledge that.
Parting words from you, Anna.
No, I was just going to say, I mean, I like the idea that Brad was speaking of. I think what it all comes down to is what I sort of talked about in the beginning, which is the fiduciary duty. So we would need, in order to enact something like that, we would need to quantify the impact of. So there is some research being done on this, but quantify the impact of not taking into account the climate impact going forward. So that's what I like about the sort of forward-looking analysis, econometric analysis that we're doing is it sort of quantifies. So if you're looking, like I said, you have to look ex ante at two investments, and if one is projected to return X and the other, but it doesn't take into account any climate, then you have to, and you look at another climate-oriented investment and it's projected to return something slightly less than X. But if the impact of climate is enough to make up that difference between X and whatever less than X is, then you can sort of demonstrate that those two investments are equivalent or expected to be equivalent. And you can sort of make that investment or take that bet. But there's just not a ton of work being done on that, whatever that differential is, and being able to quantify it and sort of justify it when you're sort of in the face of fiduciary duty and having to make that in a sense a legal case towards why you invested in one investment versus another.
Well, maybe Drawdown could help with being a nonprofit, neutral nonprofit. Maybe that's an area of research we should fund. I don't know. That's something maybe for you to talk to Jon about. I like the idea if we could produce research in a white paper that guides pension funds on how they can justify allocating 10 or 15% of their assets to climate investments. That sounds very worthwhile. And maybe it's been done already, or maybe it's being done, but maybe we could help. And by the way, if anybody wants to reach me, my email is bpalmer@palmventures.com. And I do have some venture funds I can recommend that I put capital into that I think are doing some interesting things.
Thank you so much, Brad, and thank you, Anna, and everyone. Thank you, Anna, Amanda, and Yana for joining us for this this really insightful discussion, and thank you for sharing your wisdom and expertise with us. I think a lot of seeds have been planted here today. I learned a lot, and I think this will really help guide our work at Project Drawdown. So thank you all so much for being with us today. And I am going to turn it back over to Imogen and Corie to wrap us up.
All right. So, there is one question, Jamie, if you want to go into the chat, or I can just ask it. The only question in the chat that is for Anna. So Anna, if you're still on, Susan wants to know if Oregon State Pension Fund has a commitment, if you have an official commitment or pledge.
We do not.
Okay.
So we're, like I said, we're in the process of doing this climate scenario analysis, and we'll see what comes out of it. We do. There's no specific climate pledge. We do have a number of investments just by virtue of them being attractive investments, but we do have a fair bit of investments in alternative energies and that sort of thing. But no specific pledge, no specific mandate with respect to climate.
Great, thank you, Anna. Thank you so much, everyone. This was a great panel, continuum of investors, a continuum of folks that both know about drawdown and have very little knowledge of drawdown. So this was a great start. I know that a lot of investors have come to drawdown. A lot of philanthropy has come to drawdown wanting some more data. And that's where I think drawdown has a lot to offer. So this is just the beginning. I really like the idea of overlapping physics with capital, like Jon said, and finding, acknowledging that it's a Venn diagram and not a complete overlap. So where we're going from here is our second event is February 23rd, and it's going to be a fund managers meet and greet. It's going to be a cap intro event. So there's actually a call for nominations for fund managers that are funding effective solutions to reducing the effects of climate change. And we'll send out the nominations link after this. I think it'd be very interesting to get nominations of funds that are in the drawdown verticals. So in electricity, in food, ag, and land use, in industry, in transport, buildings, land, coastal, ocean, so the nature-based solutions, and health and education. And those funds don't necessarily need to be aligned with climate, but they're just doing great work in those verticals. So to be eligible for nominations, the managers have to have a track record of 3 or more years, have an excess of 100 million assets under management, and then obviously have an investment strategy that involves the Project Drawdown solutions. So the selection will be myself and Imogen and other volunteers at High Water Women. Project Drawdown is not involved with the nominations nor the selection, but we're definitely using Project Drawdown's framework and their education materials. So again, we'll send that out. Thank you so much, everyone, for this event, and the recording will be available. And so, Alyssa, do you want to close out with any words?
Yeah, thank you so much, Corie, for all your hard work and Imogen's hard work in working to pull this panel together, as well as the High Water Women Investing with Impact Committee, who all contributed to making this work possible. I also want to give a quick shout out to our panelists for an extraordinary discussion, lots of information shared. We'll be sharing out links that people have shared in the conversation, as well as a link to the replay, and posting this session on High Water Women's YouTube channel. So thank you to everyone at High Water Women, to our panelists, to Project Drawdown for your important work in calling these things to attention. And thank you everyone for attending, and a shout out to the MacArthur Foundation for funding part of this work. As here at High Water Women, please consider making a donation to support the work that we're doing, or be in touch with me if you're interested in joining High Water Women as a corporate partner. Lots of things that we can do together. Once again, thank you, Corie and Imogen, and High Water Women's Investing with Impact Committee, Project Drawdown, and all of our panelists here today. We look forward to speaking with you again in the future, and have a wonderful day and stay warm. Thank you, everyone.
Thank you.
Thank you. Bye.